Welcome, folks. Welcome to our State of the Market. I'm starting to see folks dial in. We have about 15 of our client families who are part of our conversation. Great to have all of you join us today. I'd love to give about a minute or two just for some stragglers to be part of our discussions. But you see two gentlemen with me here on our conversation for today. We got a treat in for you. Many of you have heard from Charles Freeman, our investment CFA and investment consultant as part of our team. He's going to be conducting a lot of our conversation around the markets. It's myself and him, and then our very, very one and only Jeff Lavender, who is joining us as our travel concierge. Just came off a fantastic company cruise, and we have an unveiling of our next trip that we have for next year. So love for all of you to hear more of what the Travel Concierge makes available, as well as just very, very exciting trip that I'm very excited about as well for next year. So I got some more folks dialing in, so thanks for your patience. We're going to start here in about a minute or two. There is just some functions for you inside of this Webinar Jam software. One of our favorite things to do that we allow time for is at the end of our time together, we have an open question and answer session that please, if you could, just type in the chat function, your questions, and then I will read them out loud to either then to Charles, myself, or to Jeff. All right, we are 2 minutes into it. We have 18 folks joined us for today. So again, welcome to everyone to the State of the Market. What a series of events this weekend, quite shocking, with the shooting or the attempt of assassination to former President Donald Trump. Many of you are probably wondering two things. You probably have been watching your phones and your iPads and news around how he's doing physically. Also, probably the big question is one of the big questions for today is like, hey, what's the impact of this in the markets in this period of time of elections? But there's a lot we're going to be covering today. So without any ado, let me get right on to it. Disclosures is, folks, we are fully licensed and bonded and rightfully right to be able to have these discussions with you. As I mentioned earlier, I got two great guests, Charles Freeman, our in-house investment consultant. He's the man with the CFA, which is Chartered Financial Analyst, which is basically a designation we use and appreciate and value a lot in our industry around the building of portfolios. Charles is a great assistance to us in helping us analyze the markets, as well as looking at portfolios. Some portfolios we manage together in-house, and then the review of the portfolios that we have through AE Wealth Management. And then my very good friend, Jeff Lavender, who is our travel concierge, he's with us here today as well. So we're going to transition into this discussion around the markets. Big themes we're going to be covering today is the inflation. As you all know, the Fed is looking at that as probably the indicator to determine whether or not they would be increasing interest rates. So we're going to touch base on that. We're certainly going to talk about elections. It's heating up in a big way, and boy, over this weekend, it's heating up even more. We're going to talk about wages, recession. Do we have one? Don't we have one? Are we going to have a soft landing, no landing, mid-air refueling, all these kinds of terms that people talk about. And then a little bit about metals and how that's moving the markets as well. So Charles, I'm going to give it over to you. Would you please take charge of the slide presentation and share some thoughts on your side, please?
Well, thank you so much, Hogarth. It's a pleasure to be here again with you guys today, and happy to share some thoughts. I'm going to probably run through my slides fairly quickly because I know we're on a time constraint, but happy to again answer any questions at the end. And even if we go beyond, you can shoot me an email anytime. First thing I want to talk about is just performance that we've seen year to date. basically what we've seen is a continuation of momentum trends that we saw last year, with a very small portion of the market contributing to almost all of the gains. You can see the gold line there at the on the top, and that represents what's called the Magnificent Seven. Companies like Apple and Nvidia and Amazon. There's these certain companies that really, what kind of started it all was as ChatGPT got announced towards the end of 2022. These companies not only had the investment resources from a cash standpoint, they also had a particular advantage in potentially deploying some of this new technology, and the speculation around what that might mean for the future has certainly been priced in through 2023, and that has continued to 2024. Interestingly, other parts of the market, as you see from the lines, below that, have not done so well. So we've had a very narrow market performance. And one of the things that's been the expectation going into the beginning of the year is that even though these particular companies sort of led a rebound out of the downturn in 2022, that we would start to see a broadening of performance between some of the other parts of the market, such as small caps. And we actually haven't seen that, at least to date. Again, it's really been a continuation of that narrative from these specific stocks that have really, pulled up the S&P 500. And we sort of think about the S&P 500 as being 500 stocks. But one of the things we don't really think about is the weighting within that index. And one of the things that I think is a real influence right now is the weighting of the top, and this is just an example of the top 5, is really the highest that we've seen in a really long time. We see levels of concentration like this when we get certain asset bubbles, just like we did back in the late 90s when we saw tech have a massive run back then as well. And we saw a concentration within the index. And we've, not only did we surpass that with COVID, but we're much higher than that now. So that's what I mean by a narrower and narrower performance, in the sense that there's a smaller number of stocks are contributing a much larger percentage of the weight. And because those specific companies have been benefited by the speculation around AI, and some of them, like Nvidia, have certainly seen fundamental increases with their sales of these chips that they're making. That performance is translating into, I think, a little bit of a distorted performance, in that most of the performance is within those few companies. One of the things we've talked about is a number of very reliable recession indicators over the last few years that have not really produced a recession. This is one of them, called the Conference Board's leading economic index, and it's 10 different factors about the economy that, when they fall below a certain level, 100% of the time, going back to the 60s, we've seen our country fall into the recession. We saw that several years ago, but we actually haven't seen an official recession announced. Now, some people might argue that there are parts of the economy that are in recession, but we haven't seen specifically unemployment go up, which is a big factor during a recession. And we've even seen that start to turn around and things kind of improve to some degree in the beginning of the year on a broader sense. So the question, I think, that continues to be is going forward is, are we kind of due for that recession, and the stimulus from COVID has just kind of pushed that normal timeline out, or are we truly in a different situation where, we've been able to kind of to mitigate a lot of these different factors, and we'll end up above this red line later this year. That's something we're watching pretty closely. Other recession indicators like the inverted yield curve is still inverted, so that's an issue. And we're also seeing some things with employment, which I'll get to in just a second. One of the things kind of going back to that dispersion between the Magnificent Seven and the rest of the market, and this is a chart that shows the percentage of stocks that are actually outperforming the index. Because that weighting of those stocks is so high, and the performance of those stocks has been good relative to the rest of the market, we're actually going back to a very similar situation that we saw back in 1988 and 1998 and 99, where we have the majority of the stocks in the index are not outperforming that base index number. So that's another just example of the concentration levels that we have, and how the performance is really narrowed to just a few different companies. It's really hard to not go a day without hearing some news regarding NVIDIA. And I know that it's very prominent in a lot of portfolios because of their performance. And, in case you're not familiar with it, NVIDIA is a company that makes, the chips that are being used with AI. And there's been a massive kind of demand for those chips from various companies and the government, actually, to buy those chips as they are starting to, use and develop programs with AI. It's very reminiscent of Cisco back in the late 90s, to where Cisco was a hardware company that developed, specific hardware to essentially create the internet. And, and obviously that was another massive technological breakthrough. And, what was interesting about that particular time is that they were going to create the foundation and for the internet. And they did that, actually. They went on to really provide that hardware and infrastructure. The challenge is what the company does and then what the stock price does can actually be two very different things. So one of the things we saw with Cisco is that the stock price ran up, dramatically as the speculation around, company earnings and company sales and what they would do, what that was going to be in the future. And even though they ended up realizing a lot of those things, they didn't necessarily realize all of the expectations as they had been priced into the stock price. And then you also had competition and other variables that kind of stepped in. And what we ended up seeing was, over time, that stock price fell, by about 90%. And Cisco has actually just now, within the last year, gotten back to where, the peak was that they were trading back in 2000. So, there's a fair number of similarities with NVIDIA in the sense that it's a hardware company as well. How much of that technology could potentially be replicated? Is AI going to end up realizing, a lot of the speculation that's out there? Those are questions that'll be answered in the coming years. What I did want to highlight just with this chart, though, is how, the stock price can actually go up really exponentially. But we just have to be aware that, sometimes those expectations don't always get realized.
So, Charles, can I interrupt for a second here?
Sure.
During our investment committee meeting on last week, folks, we take this is pretty serious, right? So we have 3-4 hour investment committee meetings where we look at all these different charts and what we're dealing with on a day-by-day basis. And so I'll just speak what's going on in most people's minds. A big part of it's like, hey, Hilgard, are we chasing this? Are we getting some of this? Because this Magnificent Seven is just running and it's running and it's running, and the numbers are astounding as much. It's been positive already year to date and last year. And it seems like AI is the new iPhone, is essentially what people are saying. And if the AI does anything like the iPhone and revolutionize our world, then the idea is to get in it very, very early on. So there's a very strong desire to go and chase it. At the same time, we have lived through, Charles and I have both lived through the tech bust and the bubble. So the most productive way I would say to you is this: speculation is the last frontier after a person has created enough wealth to be able to fulfill all their life dreams. If you are wondering about what to do, and if you're thinking that, look, I want some of this action, I might be late to the dance, but maybe I'm not, maybe I am. But the first thought is this, is just look at your portfolio and say, is there money in your mind, in your portfolio, that qualifies as speculative money? Do you have enough capital to be able to afford being speculative? Look and see what you're doing already, and see if there's already money assessed in these areas of higher risk. And if you feel that there is in your world money that you feel emotionally you'd be willing to risk, or risk or be okay to lose, because that's what speculative money is about, then reach out to me and let's have a discussion. We look at bigger picture trends. We see the disparity of how far this Magnificent Seven is just absolutely pulled away from the overall markets, and we're seeing a little bit of a bubble. We're seeing a bubble similar to what we've experienced back in 2002, 2003, 2004. And so we're a little bit more on the conservative side in generic terms. But the best way to be productive about it is to think of, I have some speculative capital. Let's have a further discussion. And then we can have a further discussion about that. So I just wanted to share that thought with you.
Yeah, and that's a great point. And I think, too, the other thing that people oftentimes forget when a single name like NVIDIA is emphasized in the news, it's not like we don't have exposure to that. Within our portfolios, we create diversified portfolios, and any large cap fund that, we have specific exposure to large cap US companies, and NVIDIA is a part of those funds, just like Apple and Amazon and some of these other names that we've talked about. So just because we don't necessarily have a specific allocation to NVIDIA as an individual stock doesn't mean we don't have exposure to it through other funds that we have in our portfolios. So, clients have been benefiting from this trend up, without necessarily saying, okay, we're going to buy NVIDIA individually. So I just want to make sure people understand that we have been participating, and we've also been monitoring the risks and around some of these things, and utilizing hedges and whatnot. Because, the other thing I think that it's important to realize is, just like the chart that I was showing about Cisco, what we see is the euphoria and the mania that can be created during certain times, just like we saw back in the late 90s. And you can kind of see it on this chart right here. This is called the euphoria meter, which is kind of a combination of valuations and investor sentiment and volatility through the VIX. We've actually surpassed, it's a little bit hard to see, but we've actually surpassed the mania that we witnessed back during the late 90s, given this kind of new development with AI. So a lot of times when that bullish sentiment turns into a mania, we can get a bit over our skis, and certain gains, it doesn't mean we kind of know how far it's going to run, but we do know we're in sort of a little bit dangerous waters, and we got to be prepared for that. The one thing that I did want to kind of circle back on the economy that we also were watching, and I've mentioned before, is, I've been watching, I think it's important to watch the consumer, because the consumer got a real boost out of the COVID stimulus. We got over $2 trillion of excess household savings, to the point where people were making more money sitting at home, doing nothing, than they were when they were working. And that's a highly unusual sort of circumstance. Now, we saw that spending has kind of been worked down and spent over the last 4 years. And that was one of the big reasons why we saw inflation spike up. We've seen inflation come back down on a year-over-year basis. But interestingly, since last summer, we've really seen inflation kind of flatten out. So, there's real questions as to, on a forward basis, are we going to be in a higher inflationary environment than we were really over the last 20 years? Because, post the real estate bubble bursting in 08-09, we had a massive, it was a massive deflationary event, and inflation stayed really low in spite of a lot of aggressive monetary stimulus. So we've definitely seen a higher inflation number, which is starting to normalize, but it's normalizing at a higher rate. And that's something we want to kind of keep an eye on. But the other thing that's important to note is wages. We had a lot of people leave the labor force post-COVID, and the people that were 55 and younger have really come back at this point. But a lot of those ones 55 and over, transitioned out and have stayed out. And while that kind of led to an initial boost in wages, given the labor shortage, we've started to see those wage numbers trending down. And, that's partly, I think, due to, we'll see that as demand kind of falls in general. You don't have such an impetus to keep workers. We really haven't seen unemployment really spike up higher yet, but we're seeing wages trend down, but inflation is flat. So I think on a forward basis, what we really have to watch out for is crosses, like a cross here. If we end up seeing inflation kind of flatten out and then wages come down, well, then that again puts a lot of pressure back on the consumer, as they're not able to kind of make enough to cover their cost of living. So it's a trend we're watching. And on labor too, another one of those kind of reliable sort of recession indicators has always been, when we see unemployment kind of cross above, this red line is a 2-year moving average. Whenever we see inflation kind of cross above that red line, it typically precedes a recession. Now, we saw that happen last year, and we haven't seen a recession yet. Now, and if unemployment kind of went back down below, then I feel confident that, we may not see it, right? But one of the things we are seeing over the last 6 months or so is unemployment ticking up. And the unemployment report a couple of weeks ago had it tick up to 4.1%. So rather than kind of ticking back down, we're seeing that tick up. And usually what we see, and I could run this also back to 1965, and you'd see a similar pattern. Unemployment can, once things kind of trip over a certain level, we start to see unemployment accelerate. And we haven't seen that yet. But again, that's something we're closely watching, because I think employment is one of the things that's kind of holding a lot of things together. And it can become sort of a domino effect, in that you lose your job, obviously you're not going to be able to, not only to spend as much, but then even the obligations you have from the debt side, it makes it much harder, obviously, to take care of those. So that's something we're watching too. From an earnings standpoint, real quickly, this kind of again shows that bifurcation between the Magnificent Seven and kind of the rest of the market, where you have the S&P 500, which again is dominated, by those top stocks, over 30% when you count, number 6, number 7, number 8. That is really, you think S&P earnings are going up, but a lot of that has to do with it's just a small number of companies, and a lot of other companies are really not. And then if you look down at the smaller, mid-sized companies and small companies, we really are seeing very low growth or even flat growth. So that's something else too that's kind of important. We're just seeing that very narrow part of the market, and hopefully, the bullish case is that again, small caps and mid caps will start to accelerate and follow that trend. We just haven't quite seen it yet. One of the things that has been a development that we've added to the portfolios over the last 6 months is more exposure to precious metals. And precious metals is something that I've followed for quite a long time. And what we see is when movements start to happen, there's a grouping, whereas gold, silver, and gold miners tend to move together. And we see these kind of different multi-year regimes, and that's what this kind of chart shows. As you can see where the white lines kind of divide the regimes. We've seen, downturn kind of in the mid 2000s, a flat period. We saw, really a bump up in 2019 and 2020. And then over the last 3 or 4 years, we've seen a flattening out. Well, one of the things that we started to see towards the end of 2022 is a rebound. And not only just a rebound, but especially with gold here, this top one, we saw a breakout to a new high. And anytime you have a multi-year consolidation and you have a break above that resistance line, that tends to lead to a multi-year expansion. And so we've had gold as a part of the portfolio. We've also added silver this past quarter to as we're starting to see these trends be persistent. And I think there's a lot of a case to be made that we're really just seeing the first leg of a multi-year move in precious metals. And that's an excellent diversifier for our portfolio, kind of given some of the valuation issues that we see, and then also some of the other sort of geopolitical issues. So I think that's a real positive. For the election, as Hilgard mentioned, one of the things, if you look back historically, there's really not one party that has been much better for the stock market than the other party. And actually, I would even say in recent times, both parties have just been on unbelievable spending sprees. So, one of the things I think, no matter what, no matter who gets elected, I think that those types of spending policies are going to remain in place. We're going to see larger and larger deficits because we really demographically, we can't grow our way out of the deficits. There's certainly no appetite to have any kind of austerity or raise taxes. So the only thing we can really do is sort of print our way to mitigate it as much as possible. And that's, again, somewhat inflationary longer term. So I think that's what we're going to be dealing with no matter, who gets elected. But just a quick comment about what happened this weekend. One of the things that we're seeing in the market today is kind of a jump in the market a little bit, not a ton, but you would think that given the severity of what happened would increase uncertainty, and that might be a risk off. But ultimately, what it's showing is, there's a higher probability Trump would win the election. And one of the things that he's already committed to is spending a lot more. He's also, committed to trying to cutting taxes, probably extending the tax cuts. And, but at the same time, he's also talked a lot about, raising tariffs and a more, I hate to say maybe adversarial foreign policy. That, of course, is inflationary. So, that doesn't seem to be negatively affecting the market, but certainly inflation's been a big issue. So depending on what happens there, ultimately, we'll see. But he's to the point, if it looks like he's going to win, there's a higher probability. At least the sort of the pro-market policies seem to be dominating some of those other things. So that has been somewhat favorable, at least today. So just wanted to speak to that real quickly. At the end of the day, there's so many different factors that influence the market. And one of the things Hilgard and I talk a lot about with clients is, patience and discipline are still the best investing qualities. Markets go through cycles. I've done this 25 years. I started in the late 90s, so I've seen two, major market bubbles and crashes with the tech bubble and the real estate. Also done an extensive research of market history. So, we do see these cycles. We're I think we're in a bubble now. Actually, I think we're in it's called a double bubble between the aggressive monetary policy, and now we've layered in an AI bubble on top of that. So I think trying to mitigate, some of the risks that are out there with speculation is important, and keeping your discipline will help you immensely in the long term to realize a very high return. So
another thought to that. Thank you so much, Charles. Another thought to that we are evaluating is many of you are aware of a new tool that we are using called buffered ETFs. In a buffered ETF, there is a maximum cap and there's a first line of defense here. And so we're looking at a NASDAQ buffered ETF, basically technology exposure, but with some downside protection. Let's get some of the upside, but some strong downside protection. Those are some of the thoughts and ideas we have as well. Our investment philosophy talks a lot about having a very strategic approach with about 60% of their assets have a tactical approach. That's where we over concentrate a little bit more in the areas that we can see there's more potential for growth. We bring in precious metals into it in the LifeWealth Group tactical portfolios. We use a lot of the buffered ETF strategies to create some downside protection, upside potential. We see at these levels of bubbles pretty violent movement. It could delay. It could still run for a while and then have a violent correction. So this is how we're trying to, what we call split the banana. We're trying to find ways how we can give exposure to it and then at the same time have some downside protection. And then our final piece is our personalized solutions. And this is where people that have a tech bent or they feel there's a portions of, say, maybe their Roth IRA that we have always have kind of thought about as money that we can run. This is where we want to concentrate portfolios like Zacks Focus Growth that many of you are aware of. So instead of just investing in 7 tech stock, how can we get an exposure to large cap growth and technology with a technology bent and still be up 30, 31, 32% for the year and see some places. So we try to be very strategic in where we put the risk with monies that we don't need in the short or medium term, but longer term. And then we want to measure that risk with you on a consistent basis. So during times like this, the temptation is to jump and follow along, right? The other temptation is to say, maybe you turned a little bit more aggressive because of how things are growing so aggressively, right? It's very difficult to say, hey, I don't want any of NVIDIA's growth or any of the Magnificent's growth. You just have to check yourself. You can come to me, have a discussion. We can look at risk again. We can go see if there is any space in your overall portfolio to be able to take some if you want some, or just have a discussion, a healthy discussion, should you or not, if you feel yourself so compelled to want to participate in the overarching, growth of the Magnificent Seven, if you would. So again, Charles and I look at that from 2 perspectives. One, a positive, like Charles has mentioned, you have some of that exposure already in your portfolios. Mm-hmm. And we're also looking at that from a cautionary perspective and saying, guys, this is running up so high, so far out from the rest of the markets, and that the underlying fundamentals of what we're seeing in the economy is not supporting it to this levels of strength. And so caution. And we live in this tension. It's probably the best way to say it, is we live in this tension. But I want you to know that the amount of work that happens in the background that you don't see. This is a good time for me to explain that to you and explain that we're monitoring very closely and obviously having a lot of conversations with a lot of you as we go through our strategy meetings with you. Charles, I'm sorry I interrupted you. Any final thoughts?
I just wanted to make one very quick comment about, you made a great point about, thinking about, the downside. And one of the things that people often forget, and this happened back in 07, 08, but, markets go down 3 times faster typically than they go up. And so there's a very strategic, and that's why we're taking that strategic stance of allowing some downside protections, because when you see, multiple kind of flags and, concentration risks and, things that we, crosses on certain charts that we see, I mean, these are all red flags to us who do a massive amount of research. And, they're flags for a reason, because if history is any guide, and it is, we can kind of have a pretty high confidence that, these probable events will happen. And sometimes they get delayed. But one of the reasons why we're trying to take a proactive approach is to protect you from some of the things that we see. So as Hogarth said, any questions you have, please let us know. We're happy to go into more detail on any certain item.
Thank you, Charles. If you would indulge me for about 5 more minutes, we will finish our time here together just before 1 o'clock. But I wanted to give you a few quick updates and a few announcements and a few events that's coming down that's going to be pretty cool. We are continuing to build our team. We've added 2 team members in our portfolio administration side, Chris Groman, as well as Brian Youngs. Brian's wife is very pregnant, and hopefully this week we will have another addition to his beautiful family. Both of these guys have really come alongside there in Michelle's team, Michelle and Megan, and really helping us to make sure all the money goes into the right spots. When you ask for money, it happens really, really fast. So the team is growing. We've hired, in the meantime, another planner that will be starting with us next week. He's actually today writing his CFP. We hope he's got great results. So the team is continuing to building. We love to always send you an update, a picture chart of everyone so that you know who you're talking to. Then I'm excited about some very cool events coming up. One is real personal to me. It's on August 1. A lot of times with Hilton coming into the practice and being in his 20s, we have often the opportunity to work with younger, the kids of the families we work with. And a lot of times in college years or after college years, as your career starts, there's a lot of conversation, a lot of basics that 20-year-olds and I would say teenagers really need. And so we created this very, very cool event that Hilton is going to predominantly be sharing his experience of learning from me, obviously, over the years and teaching it to folks in his age bracket. So August 1, please bring all your teenagers, bring all your college-bound kids, bring all your 20-year someones to come and join us. This is an event we put together specifically talking about the basics about cash flow management and how to get going and start building some very, very cool financial disciplines in the way that you think about your wealth. Then we'll continue to do our dinner workshops on August 13th and 15th. We're doing them downtown here in the Winter Garden at Market to Table, who is serving us amazing dinners. Some of you in the past have been very kind to introduce and bring friends. Please continue to do that. That's a great way for us to meet some folks that we can be helped of, as well as giving opportunities to those folks to come in a non-threatening environment where they can just learn first. So these events are coming up on our side. And then we have started doing this. We have about 7 podcasts. Jeff is here with us today. We did a podcast with Jeff that was really fantastic. You did a great job, by the way, Jeff, as we told you. And Kathy Glacier also was with us, and we shot these 2 podcasts while we were on the cruise. But I'm interviewing select folks that are families we serve, friends of ours that I've discovered have learned a very, very unique way. They've been great stewards of their legacy, of their life and their wealth. And they all have very unique stories that is inspirational to be thinking about legacy, to think about how we can optimize our wealth as well as our life. So you'll see this podcast series come out. It's available on Life Wealth Legacy charles.lipson.com. There's episodes there that would be continuously come in. I did another one this week. So if you would like to be inspired over a 10 to 20 minute period of time, meet some of the families, very cool tool that we are sharing with you about examples and stories. So here's August 1st, again, 6 to 8 p.m., dollar and cents. Please call us to RSVP to invite any of your family members or friends who are in this age bracket. Please come and join us for that. Then we continue to be available online in all different kinds of either quick market updates, planning areas that we're discussing. So feel free to find us on all these outlets, and appreciate you guys checking in on that. And so today we talked about things that are exciting, stressful, the markets, the overall economy, elections, a lot of things happening right now. But we also talked about fulfilling our life and enjoying the experience, enjoying the journey. I want to leave you with this last final thought. This is a new book that I've been studying. And please, when you come in, ask for your copy. I bought a bunch. It really talks about dying with zero, but it communicates the concept that we communicate so well in all of our discussions. And that is cracking the nest egg is one of the most toughest things to do, in exchanging the money you saved your entire life for more life experiences. Those are life experiences that translate for a lot of folks into travel or allowing themselves to be able to experience more, spending money to be able to allow for more experiences, whether it be travel or maybe a new car for you and your spouse, because you can, because it's affordable, because you have a very well thought out plan. Thinking about giving up your wealth during your lifetime to your loved ones, your children, your grandchildren, in a way that you're also transposing your values, the values you found to have worked for you in your life that has been real meaningful to you, as a way to leave a lasting legacy, leaning in a little bit more towards the children and the grandchildren, rewarding with some monies that you're giving to them is very, very helpful. I just recently did that with my kids, and the beautiful response I got from them was just tears. Them being so grateful that, and I'm getting emotional again, but to see the gratitude in them, because it's unexpected blessing to them. And as they all said to me, Dad, it's tough in my 20s, and it sure is. And so we all know helping our children during these tougher times, typically up to age 40, is more profound than leaving this large inheritance at the end of life. Forgive my emotion there, but it is very joyful to see when money is well received. And then finally, making an impact in your community, making a difference in other people's lives, and doing so in accelerated fashions. Again, would we want to die with $10 million in the bank if the plan is there? So we want to encourage you, please come in and visit and ask me for your free copy and enjoy the book. Made a profound impact to those who've read it already. So thank you so much for being with us today. It's been awesome to be with you. We look forward to being with you in the next State of the Market. Jeff, thank you for joining us and planning some amazing experiences. And Charles, thank you for you. Thank you for watching the markets for us on a day-by-day basis, your comments and the clarity by which you communicate. And thank you for helping me and my entire team to do the best we can for our families. Great to be with all of you all. Have a great rest of the day.
Bye.
See ya.